Hello, I'm Sebastian. Welcome to 9nar Trees podcast. Today, I will summarize and review the book. A Trader's First Book on Commodities by Carley Garner is an accessible guide for anyone curious about futures and options, especially those who want to understand commodity markets before risking real money. Rather than treating futures as mysterious or only for professionals, the book explains how these markets work, why they exist, and what makes them different from stocks and forex. Garner draws on practical trading and brokerage experience to clarify core vocabulary, contract specifications, margin, leverage, and the daily mechanics that drive profit and loss. The focus stays on preparation, building a basic framework for market behavior, learning the tools available to traders, and recognizing common errors that can derail beginners. Readers can expect an emphasis on risk management, realistic expectations, and the decision-making process behind selecting markets, strategies, and position size. It is positioned as a first stop for new commodity traders who want a structured introduction that connects concepts to real trading choices. I will give you key takeaways from this book. Firstly, how commodity futures markets actually function. A central topic is the purpose and structure of commodity futures markets. The book explains that futures were created to help commercial participants manage price risk, and that speculators add liquidity that makes hedging possible. Understanding this ecosystem helps a new trader interpret why certain contracts move the way they do and why volume and participation vary across markets. The discussion typically covers the standardized nature of futures contracts, including contract size, tick value, and expiration cycles, all of which directly affect how much a trader can gain or lose on a normal move. The mechanics of mark-to-market accounting and daily settlement are key differences from stock investing, and they influence how traders must monitor margin and account equity. Another essential element is the role of the exchange and clearinghouse in reducing counterparty risk, which is why margin is a performance bond rather than a down payment. By grounding the reader in these operational details, the book builds a foundation for evaluating markets like energy, metals, grains, and financial futures without relying on hype. This topic sets the stage for later chapters on strategy and risk by showing what the trader is truly trading, a leveraged contract with time and delivery rules, not just a chart pattern. Secondly, leverage, margin, and the real meaning of risk. Garner emphasizes that the defining feature of futures is leverage, and that leverage cuts both ways. The book breaks down how initial margin and maintenance margin work, why margin requirements can change, and how a trader can face a margin call even if a long-term idea is sound. This is where beginners often get trapped by position sizes that are too large for their account, leading to forced liquidation during normal volatility. The text focuses on practical risk concepts such as calculating dollar exposure per tick, estimating the impact of a typical daily range, and deciding whether a market is appropriate for a small account. It also highlights the difference between risk you can plan for and risk you cannot control, such as gaps, limit moves, and sudden volatility spikes around major reports. Risk is presented as a business variable, not a moral failing, and the reader is guided toward defensive habits like using stop orders thoughtfully, limiting correlated positions, and planning exits before entering. This topic is particularly useful because it reframes success in commodities as survival first and profit second. By understanding how margin and volatility interact, readers can avoid the common beginner mistake of treating futures like a cheap way to own more of something rather than a tool that requires strict discipline. Thirdly, options on futures, flexible tools with specific trade-offs. Another major topic is options on futures and how they differ from equity options. The book explains the basic building blocks, calls, puts, strikes, expiration, and the relationship between the option and the underlying futures contract. It also clarifies the practical outcomes at expiration, including how an in-the-money option can turn into a futures position, which surprises many first-time traders. Garner tends to stress that options can reduce risk in certain scenarios, but they are not automatically safer. Buyers face time decay and the challenge of being right on direction and timing, while sellers face potentially large risk and the need for adequate margin and risk controls. The discussion typically includes why implied volatility matters, how premium pricing changes around events, and what traders should consider before using popular structures such as covered calls, protective puts, vertical spreads, and short premium strategies. Attention is given to selecting expirations, understanding liquidity, and avoiding strategies that look conservative but hide tail risk. By approaching options as a toolkit rather than a shortcut, the book helps readers match the instrument to the objective, whether that is limiting downside, defining risk, generating income, or expressing a view with less capital at risk. This topic provides a bridge from basic market mechanics to more nuanced trade design, Fourthly, market drivers, seasonality, reports, and fundamental forces. Commodities can respond to unique drivers compared to stocks, and the book explores the kinds of information that move these markets. Seasonal tendencies, inventory cycles, weather impacts, and production decisions can influence supply and demand, especially in agricultural and energy contracts. The reader is introduced to the idea that certain reports and scheduled announcements can create predictable volatility even if price direction remains uncertain. The aim is not to turn beginners into full-time fundamental analysts, but to teach them to respect the calendar and understand when risk is elevated. This can include awareness of government data releases, crop and energy statistics, and broader macro forces such as interest rates, currency moves, and geopolitical developments. The book also encourages traders to consider contract-specific quirks, delivery months, roll periods, and the difference between nearby and deferred pricing. These details matter because they affect spreads, liquidity, and the behavior of charts around expiration. By learning common drivers and the rhythm of each market, new traders can better choose when to participate and when to stand aside. This topic ultimately helps readers avoid the trap of treating all markets like identical price series and instead develop context that supports smarter entries, exits, and expectations. Lastly, building a trading plan and avoiding beginner mistakes. A practical focus of the book is helping readers form a complete plan before placing a trade. That includes defining objectives, selecting markets that fit account size, choosing a time frame, and deciding how to enter and exit. The plan is tied to risk management through position sizing, maximum loss limits, and rules for adjusting or exiting when a trade goes wrong. Garner highlights mistakes that repeatedly harm new futures traders: overtrading, chasing moves, ignoring contract specifications, misunderstanding margin, and holding positions through high-risk events without a reason. The book supports a more professional mindset by encouraging record-keeping, review, and process goals rather than emotional scorekeeping. It also touches on the importance of using simulation wisely, understanding brokerage costs and slippage, and recognizing that liquidity varies by contract and time of day. Another key element is expectations management. Commodities can be volatile, but volatility alone does not guarantee opportunity without a defined edge. By focusing on preparation and repeatable routines, the book gives beginners a way to translate knowledge into action while reducing preventable losses. This topic is valuable because it integrates everything else. Market mechanics, leverage, and instruments are only helpful when guided by a disciplined framework that keeps the trader in the game long enough to learn. In conclusion, this book is best suited for beginners who are intrigued by commodities, futures, or options, but want a clear foundation before committing real capital. It is also a strong refresher for stock or forex traders who are moving into futures and need to understand contract specifications, margin, and the distinct risks of leveraged products. The benefit to a reader's life is practical. It can shorten the learning curve, reduce expensive early mistakes, and replace vague trading excitement with a structured approach to decision-making. By emphasizing how markets operate, how risk is created by leverage, and how to think in terms of exposure per tick and per contract, the book helps readers protect their time and money while developing realistic expectations. Compared with many trading books that focus narrowly on chart setups or promise quick profits, this one earns its value through groundwork and clarity. It prioritizes the mechanics and risk controls that determine whether any strategy can be executed responsibly. That makes it worth buying as a first commodities reference because it equips readers to evaluate strategies critically, communicate effectively with brokers and platforms, and choose trades that fit their account and temperament rather than copying ideas that do not match their risk tolerance. If you would like to support Carley Garner, you can buy the book through the Amazon link I've provided in the podcast description. After reading the book, please let me know what you think and share your thoughts. See you around.